brace yourself. The data out of Canada, no matter where you look, is about as bad, if not worse, than it is in the US. Let's first look at housing. The benchmark home price in Canada as of May is 822,900 Canadian dollars. That's equal to 638,635 US dollars. So the typical home in Canada costs 42% more than it does in the US, where the median hit 449,000 US dollars in May. The going rate for a 5-year fixed mortgage standard in Canada is right around 5%. At the end of 5 years, you negotiate new terms. In the US, at the moment, you'll pay about 5.85% on a 30-year mortgage. Renting comes next. The typical 2-bedroom apartment in Vancouver goes for $3,495, and it's not much better in Toronto, which costs about $3,000. These rents are up 24% and 21% respectively year over year, and almost half of Canadians say they'll have to rent indefinitely, and 64% don't think they'll ever be able to become homeowners unless they receive financial help from family or another source. Sadly, 17% don't think they'll ever own a home, period. And when it comes to retirement, things aren't looking much better. 55% of our Canadian friends say they're concerned about having enough cash to survive in retirement, and 62% of Canadians, 55 and older, delayed retirement because they're short on funds. 63% worry they'll never retire. And with Canada's inflation rate up 7.7 year over year, the steepest move since 1983, this pessimistic data makes sense. The bottom line is this. From a personal finance perspective, it can help to step out of the bubble. Things are almost as bad, just as bad, or even worse in other parts of the world, especially in nearby Canada. However, if you're an investor with cash to spare, it might make sense to look north, particularly to stocks in relatively resilient sectors that have outperformed and continue to pay meaningful dividends. Click, follow, and subscribe to the Juice email to find out more.